Good morning, everybody, and thank you very much for joining us this morning. I'm joined by Nicky Larkin of Succession Planning, Managing Director. I'm Stuart. I'm a corporate partner at Clarkslegal, and today we're going to talk about business exits. I'm going to give some practical tips around the legal aspects, and Nicky is going to guide us through some of the recent tax changes that will impact on both businesses and also exit plans of founders. So, Nicky, thank you very much for joining us today.
Pleasure. Good to see you. Thanks for everybody for joining. So I'm launching straight into tax changes, aren't I? Here we go. So back in October, it seems like such a long time ago now, but it was only like literally 5-6 weeks. So we had our first budget from Rachel Reeves. It was no shock that there was going to be some capital gains tax increases because the seeds has already been sown that was what they were looking for. What was surprised about what the rates increases and the changes that happened were, though. So the top level changes are the capital gains tax. So pre the 30th of October, so it actually was effective from the date of the budget. Previously to that, the rate for capital gains for selling your business for higher rate taxpayers was 20%. It's now 24%. So overnight, it increased by 4%. So those that completed on the 30th of October ended up with a bit higher tax rate, which is why a lot of people were trying to complete on the 29th. What we also were told, and this is going to be something that wasn't an overnight change, but something that's going to be changing from the new tax year, was business asset disposal relief. Now, this is what used to be called entrepreneurs relief, but is now BADR, BADR. They like it being called BAD. That was a deliberate ploy of that acronym. So from the 6th of April, at the moment, you can have your first million, as long as you haven't used it already. You've got a lifetime allowance of £1 million. Now, you might think 1 million, but didn't it used to be 10 million? Yeah, it did used to be 10 million when it was first introduced. It's been at various different rates. Currently, it's 1 million. So at the moment, if you sell today, tomorrow, your first million will be taxed at 10%. So, for example, if typical, perhaps small SME, perhaps it's being sold for 2 million. If it's a husband and wife team owning 50% and they're selling it at 2 million, all of that capital gains all going to be taxed at 10%, provided they haven't previously used their lifetime allowance. However, from April, that will increase. So they will pay, instead of paying £200,000 on a £2 million sale, so their combined tax, they will pay 280,000. So that's £80,000 increase. So I always talk about two because it's not that often you end up getting just one sole owner selling. Usually there is another partner, which is why I typically talk about two partners. So it's going up. So if you're currently have got an offer, if you're at heads of terms, it's really worthwhile putting on the pressure to try and make sure that your deal gets completed before the 6th of April 2025. So Stuart is not allowed off for any holidays until after the 5th of April because he needs to make sure all those deals happen. Then we've also got another increase from the 6th of April. It's going to be increasing from 14 to 18%. So you can see there's some significant changes there. It's still not what we expected. We were expecting it to go up to perhaps even up to 40%, or people are paying high like 39%. So it could be a lot worse, but obviously if you're selling and that's your pension that you're basically talking about for the future, that is going to still stay in the political. Please do stay right through to the end of the session because I do have some really good suggestions on how to minimize these increases. So back over to Stuart for some other so to the next part of the presentation.
Thank you, Nicky. That's really helpful. I thought before we go through the sort of tax angle, it would be useful just to give an overview of the different routes to an exit or a business sale. And typically, we see those is coming under three banners. A seller will find somebody in the industry, a competitor, a business that complements their business, and we generally typically describe those as trade sales. Another conventional route is a buyout, where you have the senior management team looking to take forward ownership of the trading business and releasing the founders from their ownership. And the third area that we'll explore is this concept of employee ownership, which is relatively new but increasing in popularity. So firstly, a trade sale. Typically, when you sell your business, you will either sell the shares in a company, if it's a corporate, or you may well look to dispose of a particular business stream or certain assets and goodwill. Now, if you are a shareholder, typically selling the shares is a neater way for you to dispose of your interest, because the whole legal entity transfers over. The operation remains the same. It's just the ownership that changes, but otherwise the thing that the business remains as a constant. With an asset sale, if you're a buyer, typically you may look to acquire certain elements of the business, cherry picking those parts that you want to complement your business, and that could be neater because you're not necessarily taking on the historic trading history, such as VAT, PAY, corporation tax, contractual arrangements, that you may not, as a buyer, consider relevant to what's attracted you to the target. There are a number of considerations. Generally speaking, if you're a seller, the share sale will be more attractive. You do have to consider something called 2P if you are a buyer and a seller under an asset sale, because the law provides that those employees that are directly connected with an asset or class of assets that's being transferred will automatically come across, whether you want them or not, to the new entity on substantially similar and identical terms to those that they've enjoyed with the selling entity. And of course, if you are a seller, an owner of a business, and you sell assets, you do have to consider what you're going to do with the bit that's left behind. So the company, anything that's in the business that doesn't necessarily comprise the asset sale, you're going to have to wind that down. You may put it into form of voluntary liquidation. So there's sort of cost and other points to consider there. Second route, really, the buyout route. One of the difficulties in this type of scenario is around finance. You've got a great management team that decide to take ownership of the business, believe they can carry that forward. One of the difficulties with that or challenges is identifying the funds that they are going to need to come up with to buy out the sellers. And typically, when we get involved in buyouts, we're looking to identify the funding, and you'll see on the slide there, debt is one aspect, but in reality, we typically come across a mixture of all of those. Debt being that the founders go in release their own cash, mortgage their own properties, raise money to buy out. Vendor finance is very typical, and that's effectively where the seller is lending money to those managers looking to buy in by either predominantly deferring part of the sale process over a period of time. Some businesses are attractive to PE, and PE is a form of institutional investor that will typically look to go around and buy businesses that complement others, the net result being that the collection is greater in value than the sum of the parts, and they will then lead to an exit down the line. Now, one of the things with private equity is you're unlikely to get, if you're a seller, receive all your money on day one. They will want you to commit to their exit plans and the fund's exit plans of the project, which may be some years down the line. And then we have mezzanine finance, which is effectively a combination of all of the above. Employee ownership, as I say, is a fairly new concept. Came in around 2014. We saw this hit headline news around the sort of 2018, 2020 mark, when some high street names went through the concept. You may have heard the term with employee ownership, the John Lewis model, which is ironic, really, because John Lewis is not an employee-owned a company that's owned by an employee ownership trust. What do we mean by employee ownership trust? Well, ultimately, the sellers will sell their shares to a trust that's set up for the benefit of the employees of the company for the time being. The deal is typically structured with funds available for distribution as part one of the consideration payable, with the balance payable based on the profitable performance of the company over a period of time. Now, when you look at employee ownership, the things to consider are the need for clearance. There are some very complicated rules around taxation relating to employee ownership. There are some very strict rules around market value and fair value for the company. So you may not necessarily get a premium for your shares that may be payable by a competitor if you went through a trade sale route, for example. The advantage for sellers is that if you comply with the rules and you have the ability to dispose of your shares into an employee ownership trust, is that the transaction is tax neutral. So therefore, there is no charge to CGT, there is no charge to income tax, and the various reliefs that Nicky will explain the changes to you shortly won't apply, because you won't pay any tax on the sale of your shares to a qualifying employee ownership trust. Irrespective of the three routes, the process of selling a business normally comes down to these four constituent elements. The first is due diligence, where the buyer will look to look under the bonnet, as it were, of the business. They will want information around the operational element of the business, the contracts, the customer information. They will want to understand the makeup of employees, their terms of engagement. They will want to understand the financial and tax position of the business and its historical positioning. They will want to understand whether or not there are any issues that might affect them from a borrowing perspective, whether there's any ongoing litigation, whether there's any other issues that may arise, and that due diligence process is quite extensive. You'll then move to a sale and purchase agreement, which will document the transaction. I'll come on and talk a little bit more about that and how it relates to disclosure shortly. And then you'll end up dealing with the post-completion matters such as pay the appropriate stamp on the share, transfer, dealing with the corporate filings that companies has, and generally managing that transition on an operational level with the employees and other stakeholders in the entity. One of the things that I always say to clients when we're looking to get involved in disposing of a business is start early. Due diligence. You can save yourself a lot of time and heartache by taking a critical look at your company or business well before you get to a heads of terms stage or indeed want to sell it. Getting things like your filings in order at Companies House, making sure your share registers are correct, understanding your forecasts and your budgets, making it clear that your intellectual property, whether that's your website, whether that's the recipe for the secret sauce or the know-how that you make, has been appropriately registered, documented. Don't just assume because a third-party provider has procured this information or procured the IP for you that necessarily sits with you. Make sure that your senior and key employees and management team are on service contracts or employment contracts that contain reasonable restrictive covenants to protect the goodwill. Do make sure that if you are a business that relies on customer contracts that are of a long or medium term nature, that you don't just have a sea of emails recording the relationship. Do try and put those into a form of contractual commitment that will raise the value of the business if you've got those customers tied into you for a period of time. The sale contract normally comprises two parts. The first part deals with the fact that the sellers are selling and the buyers are buying, and it will document the consideration payable. And if it's deferred or it's going to be paid out over a period of time, record that fact as well. The second part is around these things called warranties and indemnities. Now, in any sale and purchase contract, a buyer will ask for the seller to represent and warrant the operational performance, the employees, the assets. They will want to assume that the company or the business is 100% perfect, that all your customers pay you on time, that all your employees turn up and do what they need to do, that there are no issues in the business. That will be their assumption. Now, quite often there are issues, and we will go through a disclosure process to protect buyers for breaches of those warranties and indemnities, and I'll come on to that in a second. But what I want to just point out here, when you have these warranties, representations, and indemnities in a sale and purchase contract, is to explain the difference between a warranty and indemnity. If you warrant a particular point and it's not true or correct, the seller will be liable or could be liable for a breach of contract claim by the buyer, and under the terms of that contract claim, they have a duty to mitigate their loss, and there are principles around remoteness of damage that can protect, water down any claim that they may have against the seller for a particular breach. An indemnity, in very simple terms, means that the person giving the indemnity is not, if sued for a breach, is not able to go to a bar and say, you have a duty to mitigate your loss. There are remoteness of damage principles that can apply. If you indemnify something, you don't have that level of protection. So the point being that when you're dealing with a sale and purchase contract, you will be asked to give those representations. Make sure they are contractual representations. Make sure that you are not inadvertently indemnifying anybody for those warranties. And if you do have to give indemnities, your advisors should be making it very, very clear that they need to be limited and very, very detailed as to what precisely you're indemnifying for, because of the potential financial impact on the person giving the indemnity going forward. So the way in which we as an advisor would protect a seller from a breach of warranties is through this process or concept of disclosure. So in the sale and purchase agreement, as I've said, there's warranties and representations about all the aspects of the business. They assume that everything's perfect in the business. And what we have to do is we have to go through those warranties with our sellers, and we have to identify whether or not there are issues that are such that we can't give those unqualified warranties. And what we end up doing is giving narrative and information and supportive documentation through something called a disclosure letter that gives detail as to what those particular qualifications are. And by doing so, we are protecting our sellers from a potential breach of warranty or representation. There are lots of different definitions or attempts to define disclosure in a sale and purchase contract, but ultimately we do need to ensure that we're giving enough information to give the general nature of the issue rather than going above and beyond, so as we have a protection against those warranties and representations through the disclosure process. Well, that's more than enough of me. I'm now going to pass you back to Nicky, who's going to talk about optimizing your enterprise value through the sale process. So, Nicky, over to you.
Thank you, Stuart. And just so you're aware, please do put any questions that you have for Stuart and myself in the chat box. We will be taking questions at the end, and we'll be really delighted to answer any of your questions. So I'm going to be going through 3 areas really: enterprising your value, timelines for the sale, and then, as I promised, a few tips on minimizing your capital gains tax charge. So we can go next slide, Stuart. Super. So I actually wrote another post on LinkedIn. If those that might be linked to me on LinkedIn, if you're not linked to me, I generally write a post most mornings. This morning I did write it about when is the right time to sell from a profit perspective. This graph here is showing the transition in your business through the different revenue stages. So it's at the very, very start of your business when you're pre-revenue essentially, and then as you grow at different rates through the different life cycle of your business. Now, what you will typically find with SMEs is most will not sell in the seed and development or startup stage. The ones that do is typically because they're some sort of technology business. So they've got huge amounts of R&D. They'll have put a lot of money into a lot of money and time into building perhaps some software or some other type of product or service, and they their whole setup is that they were aiming to build up to develop it to a certain stage and then exit. So and that's often why you've got people like Microsoft, etc., who have incubators and will be trying to look out for those type of those type of really high development businesses early on. Those are generally not the ones that we're talking about today, but obviously they do have certain elements the same. most of the SMEs, do have had their business perhaps 10 plus years. Sometimes it's, you've grown it through, so it might have even gone through a couple generations of the family. So it might be sort of 30, 40 years plus business. So with most sectors, you will find that there's a stage where you're maximized out at your revenue, might be maximized out as your profit. What you want to, in the ideal perfect world, if you had a crystal ball, is to work out when you would be maximizing your profits so you can get the best time for selling your business. So it's a mixture between maximizing your profits and also where the market conditions are best, you're going to get the best multiples for selling your business. So the value of the business is the highest. So what I was talking about this morning, in certain sectors, there looks to be either flat growth or even decrease, a declining growth next year. So actually, for some businesses, it's the right time to get out now before their profits start to slide. And while they can still, they've got a couple, 2 or 3 years of good consecutive profits, time to go. That's if you're selling on a multiple of your profit. People will talk about a multiple for EBITDA. Essentially, it's an adjusted profit figure. So lots of businesses, that's how they are valued. It's usually on the profit. So it might take the average of the last 3 years. And it will be, depending on the sector, depending on the quality of the business, a multiple will be applied. So it could be something as small as, a 4-time multiple. For certain business might go up to 10, 11, 12, or even further. But what you're wanting to do is really you're trying to balance, but lots of different things. You're always trying to balance a lot of different things when you're trying to work out the best time. But a good rule of thumb is looking at when are you going to peak your profits. So, what future earnings would you get from the business if you continued it versus if you sold it now? Also, looking at the potential tax changes, of course. At the moment, we can already see that, there is going to be, it's not massive tax changes. Lots of people no need to take any huge drastic action. But, if you are intending to sell in the next 18 months, obviously, perhaps might be worthwhile selling sooner rather than later while it's lower taxes. But again, it really depends on your certain circumstances. So thinking about the right time to sell is very important. So it's really a good idea to talk to your business advisors, if you've got any Ds on your board, and talking to corporate finance or business advisors or brokers that are specialists in that field that will actually understand the lay of the land. Because, again, multiples do vary depending on the rate of the market. At the moment, the market is pretty good and quite buoyant for purchases. There's a lot of buyers around that are looking to acquire businesses. So at the moment, it is quite good. If there was a global recession in 18 months, I'm not saying there is, but if there was, that quite likely would push down, so there'll be fewer buyers and therefore it will suppress your multiples. So it's difficult to work that out as an individual business owner. It's still going to be ultimately your judgment call, but it's a good idea to talk to experts in your sector to see when they would advise is best for your business to sell. Going to the next one, Stuart. Okay, so getting the mechanics of the deal right. So Stuart talked earlier about the different types of sale that you can do. The mechanics of a deal is relevant to whichever type of sale that you do. So, for example, he mentioned private equity, and he said that often you won't actually get your earnouts until perhaps 5 years down the line, or whenever the ultimate exit of the firm is. That's if you're the seed buyer in there. Sometimes a private equity backed business will buy you, but they're not interested in keeping you. They're just looking for your business. Then it might be easier timing of your sale. What you're doing is you're balancing your offers. No two offers are the same. You've got to be very careful how you balance them I always say it's like comparing apples and oranges. You need to look at all the different mechanics within your deal. So some of the things that you need to be thinking about are how much you paid on day one. So on the completion date, so that's the day you sign your sales and purchase agreement, how much money are you going to get on that date? Obviously, the dream is if you can sell 100% and get 100% of it all on day one, and you get all of that payment then. In reality, that's not very usual, unless it's either a small deal or if it's a deal to somebody who's got billions and billions. It's very rare. I've been involved in 100+ deals. Literally less than the fingers on my left hand, I can count the amount of deals that got paid 100% on day one. So that is the exception to the rule. But what you want to still get as much of that on day one, whether it's 100%, 80%, 70%, 50%. Really I always try and make sure push not to have less than 50% on day one. Because you want to make sure you've secure. It's got to be exciting for you to sell, and you want to have that cash in your pocket. And obviously, the cash in your pocket now is going to be worth more than in 3 years' time or whenever that deal will be. The other element will be to compare is that timings of that sale. So it may be, say that somebody offers you £10 million. They may say, right, I'll give you 5 million on day one, 2.5 million in a year's time, 2.5 million on the second year anniversary. Quite straightforward, quite simple. You can quite easily see, actually, yeah, that's fine. Not too long. It's good. Where it gets concerning is where people start doing 3, 4, 5+ years in their deal. Now, the reason why people try to avoid it as a seller is that if you're trying to leave that business, you're going to have less impact upon that. And so, especially if there's some sort of earn-out element, you're worried about two things. One, the fact that value is worth less if you have that money in the future, due to inflation, etc. But also the impact of how you can affect that earn-out if it is an earn-out. If you can try and just get deferred considerations, that means it is solid, it is £10 million, it's definite, it's not dependent upon revenue or EBITDA values or anything else that's going to happen in the future. It's going to be exactly that 10 million, just depending on the timing. Then that does reduce your risk. Again, it's fabulous when you do get a deferred consideration deal. However, in the UK M&A market, that's again pretty unusual. And again, you normally when you see offers, and obviously, I've been involved in 100 deals, but I've seen even more offers. The majority offers will want to, the buyer will want to de-risk themselves. What they're worried about is they're going to buy something and then actually it's not going to be worth the same amount in 2, 3, 4 years because perhaps there's the clients were as sticky as they thought. Perhaps, the staff do an exodus, whatever else it might be. There might be some other skeletons in the cupboard. So what they will try and do is they want to make sure that they're securing that they can pay for that full deal from the profits from the business and to an extent, and various other things. So if they can de-risk it by putting in earn out, then that is what they will do. So we've got the amount of the actual consideration, we've got the timing of the consideration, we've got the percentage of the considerations. Those are just 3 different things. There's also additionally, you've got to think about if you're going to stay in the business for a period of time, how much are you going to receive as a consultant or as an employee. So that's another element because, some people will have, I've seen it literally in recent deals. Some businesses will value you less than others. Some will be perfectly happy to pay 150 grand a year for you, but others will be saying, well, actually, no, I'm only going to pay 50 grand. So that can be quite a substantial difference as well that you need to add into your deal of whether one deal is better than the other. An additional point can be what you're looking at is if you perhaps own the property of your business. So whether are they going to buy the premises or not, or are you going to be renting it out? So thinking about that as well. So there are so many different elements in the mechanics of the deal. You've got to very, very carefully compare these. Another example of considering it's not just the mechanics, but who are you selling to is I've got a classic example of quite a few years ago now, but there was an accountancy practice being sold. One offer, lovely multiple, I think it was about 1.2 at the time. That's not, not a bad multiple for a small practice. Another practice, though, was offering them 0.8. And you're thinking, oh, that's a really rubbish multiple. Why did they sell them? However, the reality, when you looked and dug into the details of the other practices that they bought, they always managed to increase the amount of value going through the business because they found other additional revenue streams. They always were increasing. So your earnouts were getting more and more. So although it was still of a 0.8, the actual value that 0.8 was being applied to typically was much more, whereas you did get other potential buyers that actually were just stripping out clients. They weren't bothered about half the clients in the practice, and they were quite happy to let half of them slide. And then, well, if you end up with only 50% of the clients worth, and you're getting a 1.2 multiple, in fact, you're actually ending up getting 0.6. So if you compare to the one that did 0.8 and actually retains the clients plus sells more, you're going to get more. So it's being very careful, being really savvy with who is that's actually buying you, understanding the mechanics of the deal. When are you going to get money? What money are you going to get? How are you going to get it paid? Another facet in here, which is why, it's getting so many different layers and get more and more complicated, is there is more and more where people are doing a certain amount of share retention. So it might end up being that, yes, I'm going to sell my business, but actually I'm happy for some of my shares to be swapped into the group shares. So then again, you need to really balance out of actually what cash do I want from the deal? So how much percentage of my business do I want to sell now? And how much actually am I gambling, because it essentially is gambling upon the future worth of those group shares at a later date. So this again is why it's really important to have really good advisors during your deal, so that you can really compare all your different offers very, very carefully and try and make sure that the mechanics of your deal is negotiated for the best thing for your particular circumstances in your business. Okay, next part. So timelines. So this is particularly pertinent when you've got different things that are actually changing and going to affect the deal, where you've got different tax rates changing. It's really important to understand what process you have to follow in a deal. Stuart's already mentioned a lot of these points, so I'm just going to just very briefly go through. But this is our typical chart that we give to clients of how normally it would work. You instruct the broker and business advisor, as in succession planning, because we are great, or there are other brokers obviously available, and then how long it takes for each area at each stage of the deal. So you've got, you've first of all got to make the decision, who are you going to appoint? That can take you a while to decide the best who you want to appoint. At that point, you start off with the marketing. That usually takes at least a month. Sometimes it takes 2 or 3 months, because sometimes the sellers take a bit of time to get all of their information up together, and we're putting it in the best possible way forward. Then then you're talking to the potential buyers. We're advertising it out, and you use multiple streams, and doing that again, typically for an SME, we're talking 2 to 3 months. Then we've got potential buyer meetings. We try to get them over a month time frame. Sometimes that was shorter, sometimes it's longer. then you've got to decide which offer you're going to go forward with. At that point, you're also appointing your solicitors, Clarkslegal, obviously in the frame, other friend assistants available, but Clarkslegal are fab. And then your lawyers and your advisors are helping you get to the actual completion stage, because there's still a huge amount of work at this level. Now, that in there is, we're talking there typically 9 to 12 months. Now, sometimes deals do happen much quicker. We did a £6 million security firm this year. We did it from start to finish in 5 months to completion. Great deal. That happened really quickly. Other deals, stop and start. They might, get to heads of terms, then the buyer might change their mind, or the seller might change their mind, and you're back to the drawing board and you're going through. So, typically it could be anything for the SME from 6 months to 2 years. It can be quite a long process. I mean, and sometimes the more complicated you are, the more bigger. I mean, I know some other friendly corporate finance people that do bigger deals than we would do. They've done a great deal. 4 years it took. So you've really got to be planning. If you're thinking, I'm going to be in a cruise and I'm going to be retired from summer next year in summer 25, well, actually think about all the things you've got to do before then. You might not actually make that cruise on time. So you've really got to plan. So, I always say, sorry, Stuart, you can bored of this. Best time to plan your sale is when you're starting your business. That's the best time, But in reality, very few people are planning for their sale at the point where they're starting the business. They're too busy working out what exactly you're going to do in the business. Where do I find my clients? How am I going to market, etc., etc. But really planning, the sooner you start planning, the better. And hopefully then all of these areas can get shortened down. But, you've got the balance between how quickly do you want to push it through, but also you've got the balance, you want to get the best deal. But I don't recommend eating it out too long, because there are, yes, there's lots of buyers out there, but they also have short attention spans. If they don't think you're serious, they're going to move on to their next target. So you really need to be really focused, using good advices, etc. And getting through the timeline. Okay, getting into the juicy bit on the tax savings. Okay, so these are not a full and final list. These are just a few ideas of what you could be thinking about to minimizing that capital gains tax bill. If you're not going to be selling for a few years, you may want to start transferring your shares to a spouse or other family members so that they can potentially use their BADR allowance. Before you do that, please do get advice from your tax advisor, because you want to make sure that it's done in the proper fashion, that it doesn't trigger any tax to you at an earlier stage, and also to make sure that they will actually qualify that BADR allowance. So, but it's a good idea if you're thinking about perhaps selling in 27 or 28, start thinking about that now and get your advice quickly. If you've got surplus cash in your business, consider, a very tax efficient way is maximizing your pension pot. I've seen that a lot recently in deals where, people might have $1 million, $2 million odd cash just sitting around. Well, why not just push that into your pension pots, perhaps push it into your spouse's pension pots as well. You can go back up 3 years. So, if you haven't been using your allowances, you might even be able to put in a couple $100,000 into your pension pot. What's great about that? Corporation tax relief. So it's going to reduce your corporation tax bill. It's going to be a tax-free amount that's been taken out of the business that's just going to be sitting into your pension pot for you to be able to do something with at a later stage. I'm not an IFA, so they will advise what you can do with it later. But putting that is a very good idea to maximize up yours. Don't just think about you, but think about your spouse, think about, other family members, if it is a family business, to utilize that. Because although most sales will be perhaps the multiple of your profit plus the net cash on your balance sheet, inevitably there's often some erosions on what that cash is. So it's actually a lot more tax efficient to just take it out through the pension if you can, but you've got to get it at the right time. If you're not intending to use the money initially, you may wish to sell, but via a slightly different structure. So rather, if you hold your shares personally at the moment, it may be better if you're selling it from a personal service company or a holding company. Again, get advice from your tax advisor. I mean, I know that one of our tax advisors in my sister company, Goringe Larkin, is doing this for a business at the moment. They're setting it up so that when they do have their eventual sale in 5 or 6 years, which is what they're planning, so they're planning for it now, they're thinking, well, actually, I don't know what I want to do with that money. I'm happy for it to sit, and my shares to sit in a personal service company, that money to sit there, and then I can do what I want with it. I can make it perhaps into a family investment company. I can turn it, there's lots of different things you can just play around with it. If necessary, you could just, dissolve it, do a members' voluntary liquidation and still end up paying capital gains tax if you so wished. But it just gives you more options. We don't know, the tax rate could be 40, 50%. It could even be, in 5 years' time. So to minimize that risk of that, if you're wanting to sell, because you want to sell when it's the best time for the business, not where the tax is. So talk about whether that will be worthwhile. It might not be worthwhile for some smaller businesses because of the cost of putting in different structures. But for if your business is of a significant value, you might want to consider and have a chat with your tax advisors whether that might be appropriate for you. Again, clerks can help with the structures and everything, and obviously my lovely friends at Goringe Larkin can help with the tax advisor. Considering the timing for completion carefully. So again, I've been saying this for several months now. If you're trying to complete before the 5th of April and you're not particularly big size business, you need to be getting your heads of terms done now. You need to be trying to aim to complete in January or February, because trust me, obviously lovely lawyers are great, but they're going to probably have a lot of businesses that are trying to complete in March. And, you don't want to be at the lower part of the queue because, there's bigger deals being done. So I really do
Capacity to help you.
Yeah, obviously they have capacity to help you, but also realistically things can go wrong. So that's why I never like to put the date as the 31st of March, for example, because things do go wrong. So always try in your schedule, try and plan for earlier times, because they might find, oh no, actually we need to have such and such, or the funder needs something extra. So always build a lot of contingency. Don't just go, oh yes, we're going to compete on the 5th of April because something, yes, clerks will have capacity and of course they'll look after you brilliantly, but the other things do go wrong and there might be something else that's out of your control to push it. So get your completion date at an earlier so no one is stressed by any last minute issues. Finally, consider which country you'd like to retire to. With a good bit of planning, you may find that you could be in a country where you don't even have to pay capital gains tax if you are not tax resident in the UK. So again, talk to your tax advisor how to plan that properly. But perhaps you don't want to be retiring in the UK. I mean, a bit grey out there, a bit cold. Perhaps you want to be going off to Barbados or Madeira or wherever else you might want to go, or Malta. Malta keeps being sold to me at the moment. There's a lot. They're really trying to get lots of ex-British expats over there at the moment. So, do consider seriously, that might be something that you want to consider. You have to live there for a certain period of time. It's not a thing of just, oh, I'll just go there for the tax year. You need to usually be that. I believe, don't swear on me, I believe it's at least 5 years you have to be there to get exempt from the capital gains tax. But, that might be part of your retirement plan. You might want to go and say, right, I want to go and live in Malta for 10 years. So, do have a think. There's a lot of different factors that you're considering when you're selling your business. Some of them are tax, some of them legal, some of the cultural, some the security of your worrying about your clients and your employees for the future. lots of things to think about. And these are the bits for the CGT.
Thank you very much, Nicky. That's been, I found that very, very insightful. I mean, there's obviously a lot of things to consider, and like everything in life, it's complex and has many parts. The best places to start planning, and the best way to start planning is to go and start talking to people who can help you on that journey. We do have a couple of questions, Nicky, that come through. One, I think certainly the first one, I think mostly. Do you anticipate further erosion of CGT reliefs and other tax reliefs for business owners going forward?
It really depends on the growth. I mean, growth is forecast at, I think it's 1.8 or something. Really not very exciting figures next year, so it could easily decrease down. So if the government need to be finding extra money because, perhaps people have been offshoring rather than paying their increase in NI or whatever else, and they need to find another thing, that there doesn't seem to be any love lost for business owners. So it's very, very possible that they could go up.
Okay, thank you. And then another question. What should I be looking for when selecting advisors to help me through the sale process?
So you're going to be spending an awful lot of time, a surprising amount of time with those business advisors when you are going through the sale. Is also one of the most, for some people, it's one of the most stressful times of their life. It's essentially you're selling your baby. You don't normally sell your baby. So I think, first of all, you need to find somebody that you trust. You need to have a personal rapport with that person, because you've got to be thinking, do I want to be speaking to that person on a daily basis? Because literally, when I'm in the deal at the, towards from the pre-heads of terms, we're talking frequently. Heads of terms to completion, we're often talking several times a day, with the lawyers, with the buyers, with the sellers. So you need to be able to make sure that they're not, that they are good to that you're happy talking to them. Also, people that have got experience of going through things, because things will go wrong in a deal at some point. So you need people with experience that aren't going to panic about that, but are going to come up with solutions to the problems that come up to keep that deal on track. I mean, as I've said, been involved in a lot of deals. Just the deals that I've had this year, I've not had a single one that's not had some sort of hiccup that something could have gone wrong and could have completely derailed it. Luckily, each time this year, you keep a calm head, you've got experience, and you find solutions. And so working with great lawyers like you've got in Clarkslegal, and, people from the succession planning team, we've all got 30 years plus experience, and, you will find. So it's getting people with experience, people that you're happy to talk to regularly, and, the people that you can trust.
Yeah, thank you. I think that's right. I think personality is very important. I think you do need to have a rapport with those people that can help you. I mean, it's a sort of, you'd think it's a given that those advisors that hold themselves out as having experience in this sector do have it, but it's worth asking people, about their relevant experiences in perhaps a sector of your business. Might be worth asking them for, as we offer testimonials to of clients that we've acted for before, that can give you that level of assurance. But yeah, as you say, Nicky, you do end up spending a lot of time with your tax and sale and legal teams in these processes, and I think emotional intelligence as well. I mean, you want people that understand, as you say, you're very close to your business. It's a big part of your life that you're getting rid of, and I think you do want to be dealing with people that are empathetic to that, because it is quite emotional, and that is that I, in my experience, is quite important too.
Absolutely. No, I completely agree, and, all of our team of, are or have been business owners, and it is, it's not just sometimes about the pounds and pence that you're going to get. It's about securing the future of that business and your legacy. And sometimes it's just little things that can trigger the problems. And it's surprising how many people in it, this isn't an area, it's not an estate agent type thing. There's no point being bullshit. You need to be, those buyers and sellers are going to often be working together post sale. So you don't want to have animosity during the sales process. So I always work on a very, open and collaborative way. And buyers are often very surprised about that, because at this end of the market, you get a lot of brokers that are just, shiny salespeople, not to be rude. So they're quite surprised when we're saying, well, actually, no, we are listening to the problem that you're saying, and we're coming up with solutions, so that we get some really good feedback like that from the buyers.
Great. Well, thank you, Nicky. I'm just conscious of time. Leads me to do two things really. One to thank you all very much for your time and patience and listening to the both of us. I hope you've all found it useful, or some of it useful. If you do have any questions or comments, please don't hesitate to contact us. You have our details, and they're also on the slide in front of you. We'd be happy to talk to anyone.
Both on LinkedIn as well, so happy to DM us on there as well. So phone, email, DM, whichever works for you.
Thank you, Nicky. And the other point to raise is that both Clarks and Succession Planning have a diary and program of events over the next 12 months. We both feel that the sale and acquisition market, given the current economic and tax landscape, is going to get busier and busier over the next two years. And with that in mind, we thought it would be helpful and useful to put on a number of online and in-person events, both within the Thames Valley region and London. And of course, we would be delighted to see you, as many of you, at those events as we can. So please do continue to follow us, and do reach out if you'd like further information. But on that note, it just gives me time to wish you all a very Merry Christmas. I hope you all have a wonderful, relaxing, festive break, and all the very, very best for a very happy 2025. Thank you very much.
Thanks, Stuart. Have a happy and healthy, prosperous 2025.